Yes. So good evening, everyone. It's an absolute pleasure to have you all in Masterclass. I think we'll be shortly, I think we'll take another 5 minutes to start this. Yeah. Yes, Tej, I can see you now. Yeah.
Okay, great.
So I think Pramod Tej, right? Pramod is just joining.
Yeah, Pramod should join. Let's wait for a minute. Otherwise, we can begin. Not an issue.
All right. All right. Yeah, we also have some more attendees joining. So, yeah.
Okay. Pramod is here, I think.
Yes.
Hi, Tarun. Hi, how are you?
Good, Pramod. How are you doing?
Good, good. Good to see you.
Yes, thank you. Thank you for joining. Yeah. So I think let's start. I think people are joining, but let's start. It's 5 p.m.
Sure.
We are scheduled to start. Great. So thank you all again for joining. Let me quickly start with a background that what is this masterclass all for. So from last 6 months, every month we take one evolving topic, which is very relevant in the current market, and we try to get special and expert to talk that subject. And today we have with us Pramod as well as Tej Shah from Pramod Gubbi and Tej Shah from Masterclass. And it's an absolute pleasure to have you both. Thank you so much for joining us. Yeah. Before I start, I just want to give some basic housekeeping rules that please keep on posting your questions, because I know this is a very relevant topic in the current environment and everyone will have a lot of questions to ask. Please keep on posting your question and we will try to take each questions, as well as please take the poll before leaving, because this feedback will be valuable for us. So why did we selected this topic? So our topic for today is banking and financial sector. And as we speak, we know last 1 year, this sector, if I look at BankX in total has delivered negative 50% return. Correct, Pramod? It has delivered almost 20% negative return. The banking index. Yes. So in this background, a sector which is down, and starting with this sector from 2014 onwards, it's going through a lot of stress, starting with the Raghuram Rajan asset review. 2016 we have demonetization. 2017 we had a GST coming in. 2018 we had a ILNFS. 2020 we have a Yes Bank and DHFL playing out. So this sector is going through a great amount of pain in last 4-5 years, if you ask me. And investors are very jittery about investing in this sector. So, and as we speak, 30 to 35% of our Nifty composition is in banking. So it is a very important sector, because a pulse of the economy depends on banking. So it's very important for us to understand what is the future of banking and what is their thought. Because I was speaking with Pramod and I got to know that there are some stocks and some stocks in this sector which they feel are looking very valuable to them at this point of time, because the ROE expansion and everything will be much higher in this country. I became very inquisitive and I wanted to understand why do they feel, and it's a very contra investing right now. So let's challenge them and let's understand what their thought process. Let me start with a quick introduction of both our speakers. So Pramod Gubbi he's a head of sales and founder Masterclass, and he's a chartered financial analyst. He has worked with Ambit Capital, managing director and equities from 2016 to 18. He has served as a head of Ambit Singapore office from 2013 to 16, and heads the sales at Masterclass as well as the marketing efforts of the he again sits with the investment committee and discuss and approve the investment strategies of the firm. And thank you so much, Pramod, for joining. Introduction about Tej. Prior to joining Masterclass, Tej worked in Mayfield, a Silicon Valley headquarter venture capital fund, which manages almost $3 billion globally and $220 million in India. Tej spent 2 years as part of Mayfield, India's investment team, covering multiple sectors and being at the center of India's venture ecosystem. He is a chartered accountant and he has cleared of CFA exam. He holds a BCom degree from Ahmedabad University. Welcome, Tej. And I will give it to you first to start with. I think.
Yeah, sure.
I think we lost Pramod. I think I can't see Pramod. I think his network looks weak. So what we can do, Tej, I can make you the host and you can start with the presentation.
Yeah, let me do that. If you could give me the screen sharing rights, let me go through the presentation.
Yes.
Yeah.
Continue that, Tej. Yes.
Okay. Can you see this?
Yes.
Great.
You can make it a full screen. Yes.
Okay. Fine. So, like Tarun mentioned, right, the past 6-7 years have been very challenging for the financial sector. Every year we've seen some of the other challenge come up, and it's been pretty different every year. So, what was at a sectoral level around 3-4% NPAs in FY 13-14, it has doubled over the past 5-6 years. Actually, more than doubled. Now we are at 8-9%. They are expected. We are going to see even a further rise in NPAs as we go through the next 6 months. And every year, whether it be asset quality reviews or demonetization, GST, ILFS crisis, Yes Bank, DHFL, every year there has been a different challenge. So what was already a very challenging scenario for the financial sector, on top of that, in the past 6 months that we've seen that COVID has put even more pressure, especially on the weaker lenders in the ecosystem. But paradoxically, what we've seen is that every time there is a crisis like this, investors have an opportunity to make a lot of money by investing in financial stocks. So during a financial crisis, the headlines, the storylines are pretty similar. Comparisons are drawn to the crisis of the 1930s. Solvency of banks start being questioned. Business model of NBFCs starts being questioned. However, if someone were to simply invest in the bank Nifty, that is, if someone were to invest in the index itself without doing any stock selection, any stock picking, what we have shown is that an investment in the bank Nifty during the 2008-9 global financial crisis would have reaped 3 or 5 year returns of anywhere between 20 to 25%. And this is despite if someone would have invested in it 3 months before the bank Nifty hit its lowest point in the crisis. The precise timing does not matter. Similarly, during the crisis of the late 90s, early 2000s, when about 80% of NBFCs in India got wiped off, if someone would have invested in the bank Nifty during that crisis as well, the 3 to 5 year returns would have been around 35%. And again, this is an investment in the index itself. So that leads us to 3 questions that need to be answered. The first question being, how do we know that the crisis is bottoming out? How do we know that there will be an Indian economic recovery and the sector will recover? The second question is, if we know that the crisis is bottoming out, what sort of stocks do we select? What sort of filters do we run? What process do we have? Do we look at growth? Do we look at value? Do we look at management teams, etc.? And finally, question 3 is, how do we know when to toggle the portfolio? How do we know when to sell? What sort of a time horizon should we have? So we'll try and answer these 3 questions primarily in the coming few slides. So trying to answer question 1 over here. So what we have shown over here is that over the past 4 decades, in the past 40 years, we've seen 4 periods of Indian economic recovery. And all of these 4 periods have been preceded by an American recession. In other words, we have not seen an Indian economic recovery without an American recession preceding it. So the chevrons in red on this chart, they show periods of Indian economic recovery, while the areas in gray in the background are periods of American recession. So this is not a simple coincidence. There are two factors which come into play every time America goes into recession. One is that crude oil prices crash during an American recession, which is the line in orange over here. So whether it be 1984, 1985, when we saw about a 50% drop in crude oil prices, similarly 1990, 91, 99, 2001, we saw a slow and steady fall in crude oil prices, and 2008-9 was even worse. We saw a crash of about 70-75% in crude oil prices. And we've seen something similar this time around as well. We've seen crude oil prices drop this time around as well. The second factor being the US 10-year bond yield, which is the blue line on this chart. So it has been on a downward trend for the past 40 years. However, this trend gets further accentuated during an American recession as the Fed gets into action, as money supply increases. And we have seen something similar this time on this front as well. So we've seen crude oil prices crash. We've seen that the US 10-year bond yield has come down by about 1.5-2 percentage points this time around. So these two factors together, which is cheap oil and cheap money, they provide the Indian economy a 3 to 3.5% GDP boost. And therefore, with 100% correlation, what we have seen is that every time America goes into recession, it is followed by an Indian economic recovery. So that is why we expect that something similar will happen this time around as well. That ties into our view on credit cycles as well. So if we look at this chart, what we've seen over the past 25 years is that, like almost any other economy in the world, the financial system in India also goes through its own cycles. So a period of crisis is followed by a period of recovery, and that's eventually followed by a period of boom. However, it's important to note that not all lenders are able to recover through the period of crisis. Many of these lenders would perish during the period of crisis. There are some lenders which will recover, but they will have severely impaired balance sheets during the period of recovery. And then there are certain high quality lenders which will have strong balance sheets and will be able to gain market share during the period of recovery. So that is the larger macro picture on why it makes a lot of sense to invest in high quality financial stocks right now. Now we'll give you a couple of examples of high quality financial companies and how they went through the previous two crises that India has seen. So HDFC Limited during the crisis, NBFC crisis of the late 90s, they saw that their NPAs doubled during the crisis. NPAs doubled from 0.5% to 1% during the crisis. Along with that, PE ratios came down. PE ratios halved from 20 times to 8-9 times. So there was a double impact on the stock price during the crisis. One is NPAs doubled. Second was that PE ratios halved. However, what is interesting to note over here is that post the crisis, they saw their highest ever ROEs. So prior to the crisis, ROEs were 16-17%. Post the crisis, ROEs were 23-24%. Along with that, they started growing at around 25-30%. And because of this, the PE ratios also started normalizing. So these high quality lenders typically start gaining market share post a crisis because of the strength of their liability franchise, because of the ability of these lenders to raise liabilities at will. And same was the case with HDFC Bank during the 2008-9 global financial crisis. So HDFC Bank also saw an increase in NPAs during FY08 to FY09. NPAs increased from about 1.5% to 2%. And along with that, PE ratios came off from about 29-30 times to 18 times. However, just like HDFC Limited in the previous crisis, they also saw that their ROEs improved post the crisis. NPAs actually were just at 1% after the crisis. And because of this, PE ratios normalized post the crisis. So this is the story of two high quality lenders during the previous two financial crises, that they tend to gain market share, ROEs improve, their competitive positioning also improves. Now, why this happens is that the poor quality lenders struggle to raise liabilities during or post a crisis. While they are struggling to raise liability, while they are struggling to raise survival capital, these high quality lenders are able to raise deposits at will. They're not only able to raise liabilities for survival, but also for growth. So this is something we are seeing in this crisis as well. For example, HDFC Bank or a Kotak Bank, they are raising or growing their deposit base at around 20-25%, while many other banks are struggling to raise deposits. Similarly, amongst the NBFCs, we're seeing Bajaj Finance being able to raise money easily at 5.5%, while many NBFCs are struggling to raise liabilities. And because of this, the high quality lenders have enough firepower on the balance sheet to raise, to increase growth rates, to gain market share post a crisis. And also they're able to pick and choose the borrowers of their choice post the crisis. So therefore, it makes a lot of sense to invest in high quality lenders, especially during a crisis like this. Now, coming to our process of stock selection, what we started out with over here, given that it is a financials focused fund, is that we started out with about 95 stocks, all of them from the financial services sector. So it includes banks, NBFCs, general insurers, life insurers, brokers, and asset managers. Now we run these 95 stocks through our forensic filter. And what we try and do is we try and eliminate companies which have poor quality accounting. So we'll give you some more detail on our forensic filters in the coming couple of slides, but we eliminate about a third of our universe by way of this filter itself. That is, a third of our universe gets eliminated because of subpar accounting. Now on the remaining 65 stocks, we try and eliminate companies which have not done prudent capital allocation over the past 6-7 years. That is, they have not generated return on equity well above cost of equity over the past 6-7 years. Again, using this filter, we eliminate about 35-40 stocks, and then we are left with a focus list of 23 stocks. So these are stocks, these 23 stocks have cleared our forensic filter, that is, they have clean accounts, and secondly, they've cleared our capital allocation filter. Now, what we try and establish on these 23 stocks is that whether these companies have high barriers to entry or not, whether these companies have a sustainable competitive advantage or not. And this is where the research team spends most of its time. So the way we try and do that is we, of course, go and speak to the management teams of these companies, and we go and speak to the competitors of these companies. But we try and corroborate what these people are telling us by speaking to people on the ground. For example, in the case of banks and NBFCs, we speak to collection managers, credit managers, branch managers, DSAs, etc. Similarly, in the case of insurance companies, we speak to insurance agents, brokers, actuaries, etc. And that is how we've created a 12-stock portfolio. It will be a 10 to 14 stock portfolio of financial companies. We started out with a 12-stock portfolio with a median market cap of about 55,000 crores. To give you some more color on our forensic screens, so what we have done is we have devised 11 ratios. We've created 11 ratios specifically for financial companies. And these ratios, the combination of these 11 ratios finally give us a ranking. Ranking in the sense that whether these companies have good quality accounting or not. So these financial companies are ranked from a D1 to a D10, D1 being the best score, D10 being the worst score. So to give you an example of a couple of ratios, one of the ratios that we have is fee income as a percentage of net interest income. Now this ratio is typically in the vicinity of 25 to 30% for most banks. But when, say, a bank like Yes Bank, it has a higher ratio, almost twice as high as the median for most banks, that is a red flag for us. Similarly, contingent liability as a multiple of net worth, for Yes Bank, it was 23 times versus 4 times for a Kotak Bank. So basis 11 such ratios, we finally arrive at an accounting score, which is shown on the graph on the bottom left of the screen. D1 being the best score and D10 being the worst score. Now, what we also try to do is that we try to find out the correlation between our accounting score and share price returns over the past 3-4 years. And what we found out was that if you would have created a portfolio of companies in the zone of quality, that is D1 to D3, the share price returns over CY16 to 19 would have been 10%. Versus minus 25% for companies in the zone of thuggery, that is a portfolio of companies in D8 to D10. Therefore, what we're trying to show here is that simply by eliminating companies which have poor quality accounting, we can save our portfolio from a drag because of these companies. Simply by using these quantitative filters without applying any qualitative work on top of this, we can generate a good amount of alpha by selecting companies which have high quality accounting. To give one more example of forensic accounting, one more case study is DHFL. So DHFL had primarily 3 red flags. in its FY13 to FY18 financials. So when we ran DHFL through our forensic filter during the period of FY13 to FY18, this was actually when DHFL was growing at 20-25%. This was well before DHFL's financial shenanigans became public. During that period of time, there were 3 red flags that we found out. And therefore, DHFL was throughout that period rated as a D10 on our forensic score. The first one being fee income as a percentage of net interest income. Now, on this metric, DHFL ranked the second worst amongst its housing finance peers. Only Reliance Home Finance ranked lower than DHFL on this metric. Over year after year, we saw that fee income as a percentage of net interest income was increasing for DHFL. Similarly, treasury income as a percentage of net interest income, DHFL ranked the third worst on this metric amongst its housing finance peers. What both of these ratios told us was that DHFL was trying to make its P&L look much better than it actually was. So by booking fee income or by opportunistically booking treasury income, it was trying to make its profitability look higher than what it was, as a result of which its ROE also temporarily looked higher than what it was. And these two were clear red flags for us. The third metric that we track is change in reserves as a percentage of PAT. Now, what DHFL used to do was that it routed a few expenses through its balance sheet rather than through the P&L. For example, interest on zero coupon bonds and NCDs for DHFL was being routed through general reserves and securities premium rather than through the profit and loss statement. As a result of this, its net interest margins, its ROEs, profitability looked much higher than they actually were. So because of these 3 red flags, this is one example of how we eliminate companies, how we eliminated DHFL, and DHFL was rated as a D10 on our forensic score. So at a portfolio level, the portfolio construct, the way it works is that we have about 60 to 65% of our portfolio invested in lenders, about 35 to 40% invested in non-lenders. Lenders being banks and NBFCs, non-lenders being asset managers, brokers, life insurers, and general insurers. What that does is that lenders would, of course, give us higher growth rates. We see lenders growing at 25, 30, 40%, but they are essentially leverage businesses. While the non-lenders grow at 15, 20%, they provide a lot more stability, a lot more resilience to the portfolio. So even during the COVID crisis, for example, we saw that brokers grew over the past 4, 5, 6 months at 70, 80% YOY. Similarly, we've seen that demand for products like life and health insurance increases post a health crisis like this. And essentially, these are businesses which are unleveraged in the case of asset management and broking businesses, or have much lower leverage in the case of general and life insurance businesses versus the lending business. So these are businesses which are much more resilient than the lending business. They reduce the volatility of the portfolio, and these are businesses which are largely uncorrelated with each other, despite being a part of the larger financial services universe. So life and health insurance, for example, has grown at about 35-40% in the past couple of months. General insurers also have reported their highest ever ROEs, highest ever profit margins, given that they've seen a reduction of claims in the past 6 months. So while lenders might see some challenges going ahead as well, the other non-lending businesses are doing much better than the lending business, and therefore we believe that this is a part of the portfolio. While it gives us 15 to 20% growth, it is much more resilient as well. So what we saw was that if on a back test, what we saw was that if someone would have invested in the portfolio in April 2018, the returns of the past 2.5 years would have been 12%. Versus minus 2% for the bank Nifty and 5% for the Nifty, along with volatility, which is lower than the bank Nifty, and Sharpe ratio better than the Nifty. Now, the reason behind this is the table on the bottom left of the screen. That is that because of our focus on fundamentals, because of our focus on high quality accounting, consistent growth, sustainable ROEs, these are companies which during the past 5 years grew earnings at about 19-20% and also had ROEs of about 19-20%. This is during a period of time when we saw COVID, Yes Bank, DHFL, ILFS crisis, demonetization, GST, etc. So even during a crisis, during a period of 5 years, with some multiple crises like this, these were companies which were able to grow earnings at 19-20%. Therefore, we believe that these are businesses which going forward can grow at 19-20% as well over the next 3 to 5 years, even without taking into consideration the opportunity of consolidation, opportunity of financialization of savings. These companies can continue growing at 19-20%. Trying to answer question 3 on the earlier slides over here on how do we know when to sell. So we've thought about 2-3 approaches over here. The first one being that we've seen that every time we enter high quality financial companies or even the bank nifty during a financial crisis, after a 3-4 year period, the returns that an investor can make are anywhere between 20 to 30%. Therefore, one thumb rule may be that you can invest during a crisis and exit 3-4 years later. The other 2 approaches are more quantitative or more qualitative and are based on whether we see signs of a raging bull market or not. So one clear sign that we have seen over the past 15 years is when we see a large number of IPOs, when we see a large number of companies raising money by way of IPOs, it is typically followed by a large drawdown in the market. For example, whether it be 2007, 2010 or 2017, when we saw a large number of IPOs, it was followed by large drawdowns in the next year. Another similar metric is when we see that poor quality lenders are raising money by way of CP money, by way of commercial papers, and at sometimes rates which are even lower than the treasury bill yield. That is again a sign of a raging bull market, and we'll have 2 options in front of us then. One is that we move towards higher quality lenders in our portfolio, that is towards HDFC Bank and Kotaks of the world. The second one being that we increase our allocation towards the non-lenders in the portfolio, that is insurance companies, life insurance, general insurance companies, asset managers and brokers. Because like we discussed, these are business models which are much more resilient than the lending businesses. So we'll give you 3 case studies of stocks we own and why we own them. The 3 companies being Bajaj Finance, Kotak Bank and HDFC Bank. The reason that we own them is, to put it simply, that they clear our 3 filters. That is, these companies have high quality accounting, good standards of corporate governance. Secondly, these companies have shown really good underwriting skills over the past 10-15 years. And thirdly, these companies have high barriers to entry. So what is different in each of these companies is that they have got their own unique strengths, which they have developed over the last 10, 15, 20 years, and which suit their own business models. So for example, Bajaj Finance, in 2008-9, when Rajiv Jain joined as the MD CEO of Bajaj Finance, they started looking out for large profit pools in Bajaj Finance, which, they can target, they can earn 25-30% ROEs, and they could consistently keep growing the loan book also at 25-30%. That is how they narrowed down on the consumer durable financing business. And today, 10-12 years hence, Bajaj Finance has about a 75-80% market share in the consumer durable financing business. So one is that they earn 25-30% ROEs on this business. So that is a clear-cut advantage along with having a 75-80% market share in this business. The second being the multiple advantages that they enjoy by way of the business that they do. So what they do is they use the consumer durable financing business as a customer acquisition funnel. So today, about 70% of all Bajaj's incremental disbursements are made to existing customers. So once a customer is acquired, once he's given a consumer durable loan, he's cross-sold multiple other products, whether it's personal loans, lifestyle loans, digital loans, home loans, SME loans, etc. What that does is it reduces the cost of customer acquisition, reduces OPEX cost for Bajaj Finance. And secondly, very importantly, it reduces the probability of default. It reduces NPAs for Bajaj Finance because it is lending to customers on whom it has a lot of data available. It has a lot of data on repayment history. It has a lot of data on credit scores, on which other banks the customer is dealing with, etc., etc. So to give you one example of one of the segments that Bajaj Finance entered into about 6-7 years ago was giving loans to doctors and healthcare professionals. What it did was that because Bajaj Finance figured out that SME loans are impacted by many macroeconomic events, whether it's demonetization or COVID or GST, they thought about entering a much more resilient segment of the SME loan book, which was financing doctors and healthcare workers. And when they narrowed down on the doctor segment, they figured out that there are 10 lakh doctors in India. And they started gathering data on each of these doctors. So today they have a database on each of these 10 lakh doctors in India. They know which medical school did these doctors graduate out of, whether the doctor graduated out of a top 20 medical college or a bottom 20 medical college. Which part of India does the doctor practice out of? Is he practicing out of Bombay, Bangalore, Pune, Delhi, or is he practicing out of some part of rural India? What practice is the doctor into? Is he a dentist? Is he a surgeon? Is he a general practitioner, etc.? And then they overlay this data with repayment history, credit scores, which other banks does the doctor deal with, etc. And using these data points, Bajaj Finance has been able to segment its doctor loan book into 600 clusters. And this is what it has done across multiple other segments. Because of its strength on the asset side to keep on improving its data, refining its data, and therefore reduce NPAs on its asset side, it is a large barrier to entry for any other NBFC to enter and take away market share from Bajaj Finance, whether it's a new entrant or whether it's an existing company. And when you combine this strength on the asset side with the strength of Bajaj Finance on the liability side, of its ability to raise money at 5.5%, which is amongst the best in the industry, comparable only to HDFC Limited or a Sundaram Finance, that is, we believe, a pretty high barrier to entry. Now moving on to Kotak Bank. So Kotak Bank has its strengths around capital allocation. It has tackled multiple challenges over the past 20-25 years by way of super capital allocation. So in the mid-90s, early 2000s, what it did was it entered into multiple joint ventures with the globally best players in each of the financial services businesses it wanted to enter into. For example, it entered into a JV with Ford Credit for vehicle financing. It entered into a JV with Goldman Sachs for broking and investment banking. It entered into a JV with Old Mutual for life insurance. And once it got its banking license, it gradually started giving an exit to each of these players. So today, all of these businesses are 100% subsidiaries of Kotak Bank, and it has become a full-fledged financial services house. Similarly, a couple of challenges which Kotak tackled by way of its capital allocation were that in 2003-04, when it got its banking license, it had to build out a large corporate asset side. So what it did was, it in 2008-09, when multiple other banks were receding from the corporate lending market, it doubled down on its corporate loan book. It grew its corporate loan book by 100% in 2008-09, and it grew it by another 60-70% in 2009-10, 10-11. So today, about 30% of Kotak's loan book is corporate lending. It has been able to build a diversified corporate loan book over the period of past 10-15 years. Similarly, on the liability side, it had to build out a branch banking model, a granular liability franchise as well. And therefore, what it was able to do over the past 10 years is, it was able to build a granular CASA franchise. Today at 56-57% CASA ratio, Kotak has the highest CASA ratio in the Indian banking industry. 90% of its deposits are with a ticket size of lower than rupees 5 crores. So it has a very granular, diversified asset side, diversified liability side as well. And therefore, we believe that this capital allocation skill of Kotak Mahindra Bank is something which is core to our thesis. It is a unique strength which not many other banks have been able to show. Arguably, its capital allocation has been better than even a HDFC bank. Finally, coming to HDFC Bank, this is a story we all know about. Over the past 20-25 years, they've consistently grown at 20%, consistently gained market share, and with really good asset quality, NPAs of anywhere between 1 to 1.5%. And the reason that it has been able to do that is because of its strong focus on systems and processes. We call it the SOP bank. And because of its focus on systems and processes, it has been able to remove a lot of manual intervention, a lot of human intervention in most of its functions. Also, it has been able to eliminate risks in each of the new verticals that it has entered into. So whether it be vehicle financing, rural lending, whether it be credit cards, retail loans, it has maybe not been the first one to enter into these segments. However, over time, it has become the largest player in each of the segments that it has entered into with really good asset quality as well. Therefore, we believe that this focus on systems and processes, reducing risk, doing everything in a very measured manner, these are strengths of HDFC Bank, which will continue over the next 3, 4, 5 years at least. Also, we've been getting a lot of questions around what happens when Aditya Puri leaves next month, what happens after the new CEO comes in. So we've been working on this issue for the past 12 to 18 months. And we've been speaking to a lot of people at the bank, people who've previously worked at the bank. And the general consistent feedback that we've got is that because of their focus on systems and processes, even if a new person comes in, or even if an outsider were to come in, over the next 2-3 years, HDFC Bank is well positioned to gain market share. Also, in terms of their bench strength or talent strength versus say an ICICI or an Axis Bank, it has always been very similar. But because they've been more focused on systems and processes, because they've been their processes have been more robust, they've been able to outmaneuver competition, outmaneuver other NBFCs as well through multiple other cycles. Therefore, we continue to hold on to HDFC Bank in Kings of Capital as well as our consistent compounders portfolio as well. And yeah, that's it from my side. Happy to take any questions that anyone have.
I'll just add a little bit from my side before we open it up for questions.
Yes.
I'll cover two aspects, which is why I believe this is forget about the timing. This is a great product. One is both are structural drivers. The first is one of financialization of savings, something that all of us on this call can relate to. I'm pretty sure, right? Because India historically has been a country which has had a cultural affinity to save through real estate and gold. For generations, including some of us and some of our generation, have actually benefited from making money through real estate. For some reason, that seems to have stopped. Now, let's understand why that has stopped, and hence, what does the change, is the change sustainable or not? To understand that, you need to go back in time and understand why did real estate make so much money for all of us when it did, right? First is, of course, given the colonialism and everything, there was fear in the minds of the average Indian, and therefore, whatever you earn, whatever you save, you want to touch and feel it, right? You can't rely on the state to protect your savings. So real estate and gold became hard assets, as they call it, which you can see. You can see a plot of land or a bungalow or an apartment or jewelry, which keeps suggesting to you, my savings are safe. And in the process, real estate also appreciated. Why did it appreciate? If you understand the Indian economy through the license Raj and even until recently, there was, pretty big time corruption, right, across the political circles, as well as businessmen avoiding taxes was pretty much the norm. Now, you can't park large amounts of unaccounted money in financial assets. You can't really take like wads of cash and go to a bank and deposit it without being asked several questions, nor can you use that to buy stocks in the stock market, nor can you buy a large insurance policy and so on and so forth. So therefore, the only place where you could park large amounts of unaccounted money was real estate, right? And that became sort of an artificial driver of real estate prices across the country. As more and more black money got generated, more and more money got pumped into real estate prices kept going up. Because the prices were going up, even people like you and me started investing in real estate, and we also made money till a long time, till about 2010, 11. We were pretty happy investors in real estate. Somewhere in the last 10 years, that has changed. And if you ask me to pinpoint a point in time where it changed, I would point to the 2G scam unraveling in 2010, right? That created a massive anti-corruption movement across the country. Now, whether there was any genuine movement or not, there were a couple of politicians who actually benefited from that. The current Prime Minister fought his elections on the back of anti-corruption. The current Chief Minister of Delhi was at the forefront of it. So, and to be fair to these gentlemen, you can also see some of the policy movements after they came into power, whether it's demonetization, forget about the benefits or not, it did affect the black economy to some extent. GST further impacted the black economy to some extent. As a result, the back was finally broken from this whole black money segment. And therefore, I'm not saying that black money has disappeared from this country, but the pace at which black money gets generated has reduced dramatically. And therefore, the pace at which money gets allocated to real estate is also reduced dramatically. What was a virtuous cycle with more black money driving up real estate prices, that attracting more money from people like you and me, has now turned into a downward spiral. Because real estate prices are correcting, even people like you and me, although we have ambitions of buying a big house and stuff, are delaying it. And that is causing a further pressure on real estate prices. So it's not the first time real estate has corrected in the country. Even during the late 90s, a lot of you might be familiar, Bombay real estate corrected quite massively. But it was a 2-year slump with 2-year prices not going anywhere before it recovered. This is almost an 8 to 10-year slump. Never in India have we seen this sort of a slump across the country. It's not a micro market slump. It's across the country. Real estate prices have gone down. As a result, most of us have revisited our investing style to move money away from real estate and gold towards financial products, right? One clear evidence is the size of the mutual fund industry, for example, is quintupled or gone up 5 times in the last 5 years, right? Despite the lackadaisical performance of mutual funds are getting more and more AUMs. In fact, on a monthly basis, mutual funds get something like 8,000 crores in SIPs alone, right? And that's simply because the average Indian doesn't have any other avenue to deploy. Given your fixed deposit might give you something like 4% on a post-tax basis today. Even if a mutual fund gives you 7% return, you don't mind because you don't want to get into real estate. This change in trend, we believe, is structural in nature. And why do we say that? The RBI, in a survey in 2017, they published a report suggesting that barely 5% of India's household savings is in financial assets. 95% of India's household savings is in real estate and gold. This 5% compares to, say, a typical emerging market, which is of our size in terms of per capita GDP of $2,000, is something like 20%. The developed world would be more like 50%, right? India has begun that journey of going from 5% to 20%, and this will take years. This will take the next 10, 20 years to go there. But if you do the math, if India were to progress from 5 to 20% for the next 20 years, each year, as much as $100 billion of financial savings will come into the financial services industry. This could come in the form of bank deposits. This could come in the form of mutual funds or direct equities or insurance or any such financial products. So this is a structural trend which was bound to happen, and it has happened now. And given this, as you can see, the way mutual funds have benefited over the next 10, 20, 30 years, anybody in the whole financial intermediary value chain will obviously benefit from this booming financialization of savings theme. We want to be part of it. We created Marcellus to be part of it. We are benefiting from it. As you can see, the sort of growth in our own assets under management over the last 2 years since we've started it. Well, in 2 years, we are now managing close to 3,500 crores. And we think the opportunity is sky high. And the Kings of Capital is in some ways an opportunity for us to extend the same opportunity to our clients to benefit from it, for investors to benefit from this financialization theme. The second thing that is structural again, if you have heard any of us or you attended some of the other sessions that Tarun has organized for us, we keep talking about how India is a monopolized economy, right? Sector after sector we've seen is dominated by 1 or 2 companies, right? In paints, we talk about Asian Paints and Berger Paints. In cigarettes, it's just ITC. In adhesives, it's just Pidilite. In biscuits, it is Britannia and Parle and so on and so forth. However, there's one sector which is not monopolized, and that's financial services, right? Which happens to be the most linked sector to the economy. Remember, without financing, the economy won't run, right? Every business needs working capital financing. When you are putting up new factories, you need project financing. When you and I buy homes, we need home loans. So when we buy cars, we need vehicle loans. So without financing, the economy doesn't function. It's the most important sector in the economy, and it's the largest sector in the economy. It's the largest sector in the stock market as well. As Tarun mentioned right at the outset, as much as 35% of the index is in financial services. Yet, this is one sector which is not monopolized. Think about it. HDFC Bank has been around for what, 26 years now? It's barely reached 6% market share on the loans front, and on the deposits front, I guess it's even lower. Kotak Mahindra Bank, the second largest bank by market cap in India, is barely 3% in terms of loan market share, right? 56% of assets or 56% of loans still rest with PSU banks. 66% of deposits still rest with PSU banks. And as we have all witnessed over the last 10, 20 years, PSU banks are beset with structural challenges. You know, we're not saying it may not change, but there are governance challenges, there are incentivization challenges. Most importantly, there is capitalization challenge, right? PSU banks, if you ask me today, are operating at single-digit capital adequacy ratio. If you factor in the NPS properly, most of them are perhaps negative net worth, right? The government will not let them recognize this, because the moment they let them recognize this, the government will have to forcibly recapitalize. And we all know the fiscal deficit challenge. The government simply doesn't have the money to recapitalize these banks. And it's unlikely to have that. And therefore, the sort of privatization by stealth of the banking industry that we've been seeing over the years will accelerate going forward, right? The handful of banks which are better capitalized. Look at what's happened in the last 4 months. During the lockdown, which banks have raised capital? It's HDFC Limited, Kotak Bank, Axis Bank, ICICI Bank, maybe Bandhan Bank, which has raised capital, right? A handful of banks have actually strengthened their position during the crisis. And therefore, as and when the crisis ends, we don't know when. I know some of you have asked those questions. We don't know when. If you take a 3 to 5 year view, hopefully there will be an end to this crisis. When the crisis ends, two things happen, right? Automatically, credit growth or demand for loans will pick up in the system. As the economy normalizes, businesses will start growing again. They will need working capital financing. Some of the businesses might want to take opportunity and start expanding their capacity. They might need project financing. Some of us might feel quite comfortable of our economic futures, financial futures, and therefore we might say, let me buy a new car or let me buy a new house. So therefore, demand for loans will go up disproportionately. And second, you will see that the crisis would have destroyed a lot of incumbents. A lot of incumbents with very limited capital adequacy, very limited ability to survive a crisis would have vanished. We can already count on the DHFLs and the PMCs and all that. Even those who survive will be with no growth capital, right? The PSU banks, which are the largest sector in the banking space, will first need to be recapitalized to plug the holes in their balance sheets from the NPAs, and then need to recapitalize again to access growth capital to participate in that increasing loan demand. So the Goldilocks scenario of good demand and low competition emerges just at the end of the crisis. And the first 3 years after the crisis is the golden period for those who manage to survive the crisis to grow disproportionately. You have a very strong credit growth and at the same time, low competition. This is something that all of us want in business, right? Good demand, less competition. And you get that at the end of every crisis. This consolidation is the second powerful driver why you should be looking at investing in financial services. When we say investing in financial services, not any financial services company. Of course, the merits that Tej talked about, we need clean management, we need prudent capital allocation, and we need companies with strong balance sheets and competitive advantages so that they have the ability to survive the crisis, because at the end of the crisis, the benefits of survival are disproportionately large. It is unfortunate that none of us will be able to time this to perfection, which is why we time and again keep repeating, give yourself a longer time horizon. If you give yourself a 3 to 5 year horizon, you're most likely to face that 3 year disproportionate growth period in this 5 year period, right? If you can time yourself to perfection, great, but we can't. And to be honest, we believe nobody can. I mean, even Warren Buffett says that nobody he knows has an idea about where stock prices will be tomorrow, next week, next month, or next quarter. Therefore, by default, given equities inherent volatility, you have to take a longer term view. If you take a longer term view and place your bets on the right companies, when we say right, it has to be clean and competent at the same time, you're more likely to be better off in that period of 3 to 5 years. So with that, I'll stop, and Tarun, happy for you to moderate the questions, or if you want us to pick up the questions from the question queue,
yes,
that's also fine.
Yes. Thank you, Pramod. Quickly, Pramod, I touch upon some questions, and I think Kunal has asked one question that crisis in banking is not starting. And I think everyone is asking the same question, this moratorium episode which is happening. Since still everyone under moratorium, and now we have asset restructuring with a lot of banks. I can see HDFC finalizing their asset restructuring thing. How are you able to assert how big is the NPA issue? And I think this is top of the mind for everyone. So with GDP contraction of 25% this year in first half, how do you see things going on in future with this getting bigger and bigger? I speak to a lot of small and medium business owners, my friends. I think they say 40-50% what it used to be normally, and they are not able to get their fixed cost taken care. So in this environment, I know you must have done a lot of channel checks on the ground also. What gives you that confidence that things will come out fast? I'm trying to be a little devil's advocate.
No, absolutely.
Yes.
No, I mean, look, there is no doubt that NPAs across the board will increase, right? NPAs in the system will increase. You don't need to do any research for this. I can do that. I can make that conclusion sitting from my window. Looking out the window, I can see the number of businesses which have shut. Looking out the window, I can see the scanned traffic. I know the economy is contracting, right? If the economy is contracting, naturally, given financial services are a leverage play on the economy, they will take the brunt of that impact. So NPAs increasing is a given. We are not even denying that. The question is, will NPAs increase uniformly for every bank and every NBFC, right? And that's where the difference is. We're not saying by any bank and by any NBFC, they just taken pains to create that stock selection approach. One, you already have some data points. The moratorium itself, the concept you bought, right? The moratorium itself has a complete range of, say, something like 5%, which is the lowest for any bank, to as high as 80% of a book for an NBFC is under moratorium, right? In between, there are several. So obviously, there's a difference between the guy at 5% and the guy at 80%. And how does this happen? Why does one bank have only 5% of his book at moratorium? And why does one have 80% is the real question you need to ask. And the answer really doesn't come from, when coronavirus will go away, when the lockdown will be lifted, when these businesses will come back. I don't think any of us have any idea, right? There's no point in trying to do that. In fact, shift your attention from the loan side of the bank's balance sheet to the other side of the bank's balance sheet. The other side of the bank's balance sheet is liabilities. The liabilities have two components, right? One is the equity, which is your capital adequacy ratio. The other is the deposits. Now, because banks and NBFCs are by definition leveraged business models, which mean what? For every 100 rupees of loan the bank gives, anywhere between 10 to 20 rupees is equity. The remaining is all borrowings. Borrowings could be from depositors in the bank, or borrowings could be from commercial paper that you issued in the bond market to mutual funds, insurance companies, and so on. So therefore, for a bank to go bust, you don't need all 100 rupees of loans to go bust. Barely 10 rupees of loans can literally wipe out the entire equity, right? And that's why we call it the leveraged play on the economy. Now, a bank which has 10 rupees of equity compared to a bank with 20 rupees of equity in its book obviously has a different level of cushion, right? For a bank with 20 rupees of equity, you need 20 rupees of loans to go bad. For a bank with 10 rupees of equity, 10 rupees has to go bad. That itself is a difference. And like I mentioned, the sort of banks which have raised equity in the last 3-4 months during the pandemic, all of them are sitting at 20% plus. capital adequacy ratio compared to almost an average 10% for the banking system. Some of them, like I said, PSU banks, in my view, are significantly less than 10% on that. So the ability of each of these banks to survive an NPA crisis is very different to start with. The second is the deposits. And this is very, very important to understand, because often we believe, or we tend to think of banks and NBFCs are lending businesses. Now, lending is an outcome of something else. In fact, the primary business of a bank or an NBFC is the deposit taking, right? When the bank takes current account or savings account or fixed deposits, or instead compared to a bank which actually relies on commercial paper or certificate of deposits issued in the wholesale market, it makes a huge difference to their raw material cost. What is the raw material cost for a bank or an NBFC? The raw material is the money, right? The cost is at what rate are you borrowing. For a bank, current account is 0. Savings account for most banks is 3.5%. Even if you paid 5% like Kotak, it's still 5%. Plus fixed deposits, maybe you're paying 6.5%, 7% depending on. So average cost of funds for something like an HDFC bank, Tej, would be what, 5.5%, right?
Lower, 4%.
4% is the average cost of funds for HDFC. Now think of it, for HDFC bank to make 4% margins, it has to lend at what? 8%. The cost is 4%. The lending rate is 8%. He makes 4% margin. At 8%, who do you think will borrow from HDFC bank? Right? The safest borrowers in the country. HDFC bank simply can pick and choose who they can lend to. They can lend to a Mukesh Ambani, they can lend to the Tatas, they can lend to L&T, or they can lend to relatively safe home loan borrowers like all of us here who are salaried individuals. They don't have to take any risk to make that margin and return on equity. There itself, they won the game. You don't even have to do any sort of great risk assessment and pick and choose your borrower. By ensuring that your cost of funds is lower, you've already reduced the risk on your loan book, which is why HDFC Bank has enjoyed the low NPA ratios historically and even during the crisis. Compare this to something like, say, a Yes Bank or an RBL Bank, which never bothered to build a current account or savings franchise, right? Whose cost of funds to start with will be something like 9 or 10%. If your raw material cost of 9 or 10%, how much do you have to lend at to make a decent margin? At least 14, 15%. Even that won't be enough, because at 14, 15%, your borrower segment is an inherently riskier segment. Therefore, the likelihood of default from that segment is relatively higher. So you'll have to charge a higher margin to factor in the defaults as well. So you end up lending at 16, 17%. So there itself, the game is decided. You don't even have to have a great risk assessment team. Just by having a low cost of funds, you can make. On top of that, the second element that Tej talked about, which is the prudence with which you lend, also makes a big difference. Do you want to build a banking business or an NBFC business in super quick time? Or do you have the patience to build it over several years and decades? Mr. Rana Kapoor was in a super hurry. He wanted to be bigger than HDFC Bank in no time, which is why he grew his loan book at 50, 60%. Clearly, you can't build your deposit base at that pace, right? HDFC Bank built it gradually over these years. Kotak got lucky. It made, that's prudent capital allocation. It acquired ING Vaishya Bank and then made use of the savings bank, savings rate deregulation to launch a 6 or 7% savings rate scheme. Garnered a lot of low-cost deposit to the extent that Kotak now has a higher CASA ratio than HDFC Bank at 56%, right? If you've done that piece right, you don't have to worry so much about NPAs. Now, having said this, even an HDFC Bank and a Kotak Bank will see an increase in NPAs. It's just that their increase in NPAs will be lower than the rest of them to start with because of the sort of borrowers they've lent to. And secondly, they have the better cushion through that equity, 20% capital adequacy ratio, to take the hit of that increase in NPAs. Therefore, their ability to survive this crisis, again, like I said, none of us know when this crisis will end. But if you take a 3 to 5 year view, hopefully in the next 12 to 18 months, we should see an end to this crisis, either because there's a vaccine or there's a cure, or most of us have learned to live with this crisis, and therefore normalcy will return. If you have invested in the banks and NBFCs who managed to survive until that normalcy returns, you get that benefit of consolidation, which I talked about. Then economy starts recovering, credit growth starts recovering, demand for these loans start recovering, and these banks are the handful of banks left in the system to capitalize on that. So they come out of the crisis with a larger market share. Demand is increasing. These guys have a larger market share. Therefore, these guys grow significantly faster than the system. And that's what we all need to be prepared to capitalize on. And like I said earlier, unfortunately, we can't time ourselves to perfection. We have to be sitting there waiting for that opportunity. It will come. And more often than not, the problem with timing is, more often than not, the market is forward looking and the market will start reacting even before the economy bottoms out. So we can't really wait. Does that mean that we have to be prepared for further drawdowns? Yeah, obviously, yes. Right. One of the questions I saw in the chat queue is this Supreme Court case on the interest on the moratorium. It could be a hit for even the best bank's profitability, right? If the waiver on the interest. But given that moratorium itself is low, the hit on the profitability will be lower than the other banks. Again, if you're positioned to better capitalized banks, who are sitting on relatively less risky loan books, this Supreme Court judgment, if it goes, adverse against the banking system, will benefit the better banks. So in a very perverse way, this crisis is good for a handful of banks. They will use this to their benefit and come out with a larger market share. Unless your view is that this crisis will last for another 3 to 5 years, I think you should go ahead and do it. The only reason I would perhaps time it is not from a logical standpoint. It's more from a behavioral standpoint, which is absolutely fine because we are human beings at the end of the day. Not all decisions we take are rational in nature. This is what I call as peace of mind investing, right? I don't know when this will bottom out, but I don't want to be in a position to see another drawdown. Even if I buy an HDFC Bank is still 20% below its peak. In the next 3 months, if say there is another second round of coronavirus cases, another lockdown, HDFC Bank could fall another 10-20%. And I don't want to lose sleep over it. By all means, stay away from it, wait for it to come. But that option can come with a cost. The cost is possibly in these 3 months, the crisis has abated and the stocks, like I said, are forward looking and they've already up 10-20%, which is also fine. If you're investing for the long run, if you buy a stock at 10% higher price, over a 5-year period, it's not like you will lose it all. Your potential returns might come down by 2 or 3%. So either way, it's your decision, but it depends on what type of investor you are. You shouldn't kick yourself saying that, I should have listened to the Masterclass guys when they came in September and put my money there. The market is run. Doesn't matter. You chose to stay away because you wanted to sleep peacefully at night. That's absolutely fine. Or if you decide to invest, you should be prepared for a bit of pain, which again, like I said, in the long run won't make much of a difference anyways.
Thank you, Pramod. Pramod, I have another follow-on question to that. This theme of banking and financial, it's a very thematic stuff, right? A sector-specific fund which we are talking about. So how much how much percentage of net worth one should look at investing into something very thematic, because most of the diversified fund would actually have this banking in their portfolio already. So how do you get this piece right for investor? That is one question. And second question is on how do you identify mistakes early? And I know Tej has taken one slide where he spoke about lenders out of your system. You had red markers coming in much before. So for a layman investor, what do you think? Maybe Tej, you want to take us through that slide again to how do you get this piece right? Identify guys like ILNFS, guys like DHFL, because I know many of the fund managers, very respected fund managers, invested in Yes Bank. So were they not able to identify this Yes Bank crisis much before? I know many have 10% of their portfolios in Yes Bank. So how do you, and I know many clients have concentrated position, they made a lot of wealth out of Yes Bank. So maybe Tej, you want to take this question?
Yeah, sure. I'll take that second question first. Let me go back to that slide.
Because mistakes are something, if we can avoid, you can become much more successful investor.
Absolutely. I mean, that's the central tenet of our investing. If
Yes.
you avoid possibilities of losing money, making money becomes easier.
Yes.
Right? Which is not original to us. You know, Warren Buffett said that there are 2 rules of investing. First rule is don't lose money. Second rule is don't forget rule number 1, which is something that we've ingrained in ourselves, and which is exactly what Tej's forensic accounting model is intending to achieve. I'll address the first question later once Tej finishes.
Sure.
And especially in the case of financial services, this holds true even more because the margins for error in financial services businesses, given they are leveraged businesses, are much lower. So what we do is the first filter itself on our universe, the first filter that we apply is our forensic screen. So this is 11 ratios, like I said, which are specifically for these financial companies. And we eliminate about 35 companies using this screen itself. So we do not want to take any risk on accounting quality. Once these 35 companies are eliminated from our system, we do not do any additional work on these companies. We think that if there is a red flag on accounting quality itself, then these are the eventual numbers that we'll be trusting to make our investment. If the numbers themselves are not correct, then what do we base our decision on? So, for example, what we do is that these 11 ratios that we use are for the past 6 or 7 years. The ratios for the past 6 years are accumulated. These are from the annual reports. And then we take an average of these ratios across these 6 years. These are compared with companies which are in the similar financial services businesses. For example, banks are compared to banks. NBFCs are compared to NBFCs. Housing finance companies are compared to housing finance companies. So therefore, we are comparing apples to apples rather than comparing, say, a bank to NBFC. And then when we compare ratios like, say, fee income as a percentage of net interest income for a Yes Bank versus a Kotak, which are banks of similar size, they are banks which do similar types of businesses. And when we find out that these ratios are completely out of whack for one bank, then we can go back to annual reports. We try and find out what the red flag is. Why did this ratio come out to be twice as high as for most of the other banks? And then we find out that this has been consistently the case for the past 5-6 years. Then when we corroborate that with multiple channel checks, then that is something that we completely avoid. So we do not want to take any sorts of risks when it comes to accounting quality or when it comes to corporate governance practices, especially in the case of financial services businesses. And therefore, what we have shown is that only if you invest in companies which are in the zone of quality, that is the top 3 deciles, only by doing that itself, you can massively outperform, which is the 10% return that we discussed. By simply investing in companies in the top 3 deciles, you can make a 10% CAGR versus minus 25% CAGR. So a 35% drag on the portfolio, you can simply avoid that drag by eliminate companies in the bottom 3 deciles. So this is part number 1 that we do. This is based on the annual reports and financials of the past 6 years. Every year in December, we do this forensic accounting framework. We run all our financial companies through this forensic accounting framework. And then after we are done with this, then there are some other additional qualitative checks that we do. For example, how many times has the auditor changed? How many times have there been changes in the CFO? What sort of feedback are we getting from the branches, DSAs, etc.? And then we try and corroborate that feedback from what we are seeing in the forensic model. This is how we eliminate companies. We take no chances in terms of accounting quality. Similarly, on DHFL, even before FY18, it was a D10 on our forensic score. That was mostly by way of our accounting forensic screen. Also, if we would have done channel checks then, we would have got similar feedback. What we got was that they used to charge a lot of upfront fee income, which used to be 4 to 5% of the loan amount itself. When you charge 4 to 5% of the loan amount, you can book that amount on your P&L, make your fee income look higher, make your profitability look higher. And then anyone who's willing to pay you 4 to 5% of the loan amount, you know what type of borrower will he be, what is the quality of that borrower. So 3-4 years later, you're taking balance sheet risk, improving your P&L. 3-4 years later, your balance sheet will get impacted. You will see much more NPS come through when you see that fee income is a very high proportion of interest income. So we have a very high focus on accounting quality, not only by way of our forensics, but also while we do channel checks, a lot of qualitative work that we do on the annual reports of these companies.
Sure. Thank you. Pramod, you want to take the first question? How much percentage of the portfolio? It's a very sectoral thematic theme.
Yeah. So it's absolutely right that, sectoral thematic funds are naturally riskier. Why are they risky? Because there is very little diversification, right? I don't think we need to talk about portfolio diversification, right? Portfolio diversification is something that all of us understand. Even if you love the company, like us, if you say you love Asian Paints, you can't put all your money in Asian Paints. That's like really dumb. You have to diversify your portfolio so that you don't end up putting all your eggs in one basket. Like that, if you build a portfolio, I mean, the diversification comes when each of the different stocks in the portfolio are different from other. They are not correlated. If you buy 10 Asian Paints, obviously there is no diversification achieved. On that logic, if you buy all stocks from the same sector, relative diversification is less. Therefore, they are more correlated and hence the risk is higher. What does diversification achieve? Diversification reduces the risk. In the case of a thematic fund, because of the lower diversification, the risk doesn't get reduced as much. However, luckily for us, if we had tried to do Kings of Capital in 2016, we wouldn't have been able to reduce the risk further. What has changed since then? In 2016, a financial services fund would have only banks and NBFCs. Luckily for us, over the last 3 years, we've seen a slew of IPOs of, say, asset management companies, life insurance, general insurance, wealth managers, stockbrokers, depository companies. Now there is this registrar and transfer agent scams IPO coming, stock exchanges, commodity exchanges, rating agencies have been around for a long time. So that means that now you can genuinely diversify even within financial services, but across different segments. Remember, the banks and NBFCs are a leveraged play on the economy. The rest are not that leveraged, particularly if you take, say, life insurance. It's an essential product. Everybody needs a life insurance, right? Of course, there is some exposure to the economy and the market through ULIPs and so on. But as more and more term insurance gets sold, this becomes totally uncorrelated with the economy. And a lot of market structure driven businesses like exchanges, depositories, and all are, of course, different levels of correlation. Therefore, today we are able to build a portfolio which is relatively better diversified than what was 3 to 4 years ago. Having said that, you still have this portfolio which is relatively riskier than a diversified sector fund, like, say, consistent others. And you need to allocate your capital accordingly, right? Now, how much you should allocate to it, I can't say without knowing your other investments in the portfolio and also without knowing your risk appetite or your return expectations. I can give you a framework to think about it and you can apply it to your specific situation. Now, each of us have a certain return requirement and have a risk tolerance, right? And within that, we want to construct the most optimal portfolio for us. At the core of it, the first or the bulk of the portfolio should be something that can help you achieve your financial goals with as little risk as possible. The consistent compounders is a product, for example, which can deliver an 18 to 20% return with the risk measured in terms of standard deviation at something like 7 or 8%, right? Which is the risk on a 3-year rolling basis is akin to that of a government bond. Therefore, there is a term that we use called Sharpe ratio. The return over risk is something like 2.5 times for consistent compounders. It offers one of the best risk return trade-offs of the market. And an 18 to 20% return, mind you, is not bad. Most of our financial goals can be achieved if your equity portfolio can deliver that 18 to 20%. So that should form the core of your portfolio. Once you built a portfolio with the consistent compounders or some such product, which is relatively safe but still giving you healthy returns, then you can start adding a little bit of risk on top of it. This is to give yourself that extra chance to create significant wealth over years. That could be in the form of a Kings of Capital portfolio, a thematic fund like financial services, or a small cap fund like Little Champs that we run. Now, how do we quantify it? The way we look at it, it's easier to look at, say, the Marcellus employees' own allocation, because at Marcellus, we have a rule that all of us have to invest only in Marcellus products, right? We can't invest in any other PMS, any other product or anything. So all of our savings are actually either in consistent compounders or Kings of Capital or Little Champs in varying allocations. The average allocation throws a very interesting dynamic. The average allocation roughly is in the ratio of 4:2:1, which means that how much ever you put in consistent compounders, make sure you don't put more than half of that in Kings of Capital. And how much ever you put it in Kings of Capital, make sure you don't put half of that in Little Champs, or 1/4 of what you put in consistent compounders needs to go into Little Champs. Now that's, like I said, is a thumb rule based on your specific situation of return expectations and risk appetite, and what else do you have in your portfolio. You can tamper around with this sort of a 4:2:1 ratio.
Sure. All right. I think that makes us come to end of this session, because I think we are running out of. Thank you so much, Pramod and Tej, for being with us. And it was a wonderful insight for all of us to know more about the banking sector opportunity it offers us currently. Thank you so much. Thank you so much.
Thank you. Thanks, Tarun, for inviting us. And thanks, everybody, for patiently listening to us.
Thank you. Bye.